Innovative history.
Innovative history refers to the innovator firm's track record of introducing successful product innovations to the market. Notice specifically the successful moniker in this definition. This is done purposefully since some firms may be prolific innovators but may have market success that is poor or difficult to measure. For example, 3M is well known for systemic innovation, though the market success of its products can be difficult to evaluate independently, particularly since many of the company's innovations build incrementally on existing products and the firm operates across a wide swath of industries. Conversely, Apple is not known for having a large number of innovative new product offerings, perhaps 1 to 2 per year, but those that Apple does offer tend to have strong market acceptance. When evaluating innovative history, quality of innovation, not quantity per se, is thus the critical metric. Admittedly, determining whether an innovation is successful or otherwise has impact is subjective and highly influenced by prevailing industry norms. Furthermore, in many markets it is difficult to gauge a priori the value of a given innovation, which introduces time as an element in determining innovation history, as it may take considerable time for the market impact of an innovation to become clear. For example, the snowboard was invented in the early 1970s, but it was not until 2 decades later that the product and associated sport garnered widespread acceptance in the broader skiing industry. Collectively, these challenges imply that there is no simple mechanism for accurately measuring the innovative history of a competitor. Industry norms and market histories should, however, provide ample circumstantial evidence to at least develop a picture of innovation history. We argue that the decision to imitate an innovation of a firm with a favorable innovation history may be attractive. Although past behavior is no guarantee of future results, prospective imitators can draw comfort from correlating a competitor's past innovation successes with future innovation outcomes. A favorable innovation history lends credibility to the behavioral signals sent by the innovator firm, such that past successes create a halo effect over new offerings and the inherent riskiness associated with competitive imitation is decreased. 30 In terms of signaling theory, the firm's innovation history is part of its organizational reputation. For firms with an established track record of innovation, the signals they send will be perceived by signal recipients as being of high quality. When they engage in innovation behavior, prospective imitators are thus likely to pay attention to these behaviors and be inclined to pursue imitation. In other words, imitating a firm that has a history of successful innovations is less risky than imitating a firm that has not consistently introduced successful new products.